Alrighty, so Anatomy of Finance, Lecture 3, Life Cycle of Money. This is my mental model for the lifespan of all money. It proceeds in 3 stages, that sort of the birth, life, and death of money. So stage 1 is leveraging. In other words, money creation. And the way I sort of analogize this is to the idea in physics, which I'm not an expert in, of matter and antimatter. So the idea is like from nothing, we can create money and anti-money. And what that looks like is sort of assets and liabilities. And I'll give some examples of this. And then once it's created, there's trade. Money is traded. So assets can be traded for assets. Liabilities can be traded for liabilities. And then, of course, you can composite this into some special trade. And then this third stage is the deleveraging, the destruction. And this is basically the assets and the liability and money and anti-money come back together, and then they go away. So I'm going to give a couple examples of this. The first example I want to give is bank deposits. And okay, so on the right, I'll represent you. And let's say that you have $1,000 in cash. And you want, to save this at your bank account. So here on the left, I'll have the bank account. The bank, rather, represented by this building. And we have the 2 balance sheets. So by convention, the left will be the asset, the right will be the liability. And over here, the right will be the asset, and the left will be the... Just broke my convention. The right will be the asset, the left will be... So right will be the liability, left will be the asset. So you deposit the cash, and so let's consider what happens directly after. I'll use blue for this. So the cash is no longer in your hand. It becomes owned by the bank. And then you might say, well, it's not owned by the bank. It's still my cash. Well, what does that look like? Well, what you have instead is $1,000 in a deposit. But of course, the bank, when they give you this deposit, is liable to service it. So at any point, you could go up to the bank and ask for this money back, either in the form of cash at an ATM or in the form of digitally, like wire transfers, paying off a credit card, ACH, and so forth. So the bank actually has $1,000 in liability. Or I should say, $1,000 is in the liability column. The liability itself is $1,000 deposit. And this is a little confusing, but in a sense, these two form a pair. These two are the opposite sides of the same thing. On the right, on the asset side for you, the $1,000 is a promise for $1,000 in various forms, right? ATM, wire transfer, ACH, etc. And on the left, it's the other side of that promise. The bank has to fulfill the promise to you that this is an operable amount of money, and whatever you want to do with it within the sort of the rules of bank accounts, they have to be able to fulfill. So in this language of money and anti-money, this is the pair, right? From nothing, before there was just cash. But now the cash still exists, but now we have this pairing of this deposit. And you might ask, like, how is this money creation? Because, before there's $1,000 in cash, and after there is total $2,000 in assets and $1,000 in liabilities. So the difference is the same. Like 2,000 minus 1,000 is 1,000, so nothing has been created. And that's true. And furthermore, you might say something like, in order to actually turn this into money, you have to re-loan it to someone else, and then it becomes money. So a lot of people have this image that's taught in school of, you're over here, you give $1,000 to the bank. And the bank then loans $1,000 to, entrepreneur. $900 to an entrepreneur because they have a 10% reserve requirement, we're told in school, who then deposits his $900 into his bank account. And then his bank will loan $810 to the next guy, and so on and so forth. And this is sort of an image we're taught in school, and then what the final calculation ends up being is that we have to take 1,000, we do an infinite geometric series. This really gets the middle school math whizzes really excited, and you conclude that actually, okay, well, depositing money at a bank, in fact, creates $10,000, but only if it's loaned out sort of infinitely in this chain. So this idea it's not entirely inaccurate, but it's largely inaccurate. So I'm just gonna draw a big X through this. And well, there's many reasons why it's inaccurate, but for the first reason, I'll just say that the money creation does not need to go through this entire chain of loans to happen. In fact, the money creation happens just in this first link in this chain. In this first transaction, as represented by these balance sheets, money is created. And the reason why is, we can just, very quickly look at the definition of money. I'll pull it up here from Investopedia. We'll just look it up. M1 money. I'll look it up right now. M1 money supply. M1 is the total amount of physical currency, coin, demand deposits, and traveler checks, and other checkable deposits circulating in an economy. Okay, so after the transaction with the blue text, how much M1 is there? Well, there's 2,000 M1 because there's 1,000 M1 here, and there's 1,000 M1 here. So actually, we've created more M1 just with this interaction. Okay, what about another example? Example 2, very near and dear to many of your hearts, I'm sure, is mortgages. Very important. Okay, so let's do the bank, which I'll represent with this little symbol over here. And then they have a balance sheet, asset, liability. There's you, the buyer, over here. Once again, assets, liability. And then there's the seller on the right, who currently has the house. And let's say the house is $1 million. Let's say there's no down payment, just to make things simple. So you want to buy the house. So you contact the bank, you sign the terms, ignoring fees and closing costs and whatnot, and appraisers and insurance. Let's ignore all that. That's all too complicated. Just the money to buy the house. And this actually kind of happens in 2 stages. Well, 2 stages that are simultaneous, that happen instantaneously, but I'll split them up. So the first stage, I'll denote in blue. The first stage is that the bank extends you the loan. So you get $1 million in a deposit from the bank. And of course, this corresponds to $1 million in liability for the bank. And then, of course, the next stage, which really happens instantaneously, legally speaking, is that you buy the house from the seller. So the house goes away on the seller's sheet, becomes your sheet, and you spent your $1 million to buy the house. So the seller now has this nice $1 million asset in the form of a deposit with the bank. So notice here that the bank's liability between the blue stage and the green stage hasn't actually changed. What the owner of the liability has changed, but the liability itself, the bank still owes someone drawing rights, let's say, to $1 million of cash or wire transfers or ACH or etc. Okay, but the bank doesn't just do this for free, right? There's another thing that happens in the blue step, which is the when you take out a mortgage, you have debt. So what that represents is you have $1 million of a mortgage debt. So I'll just call this $1 million mortgage. And of course, the bank has $1 million of mortgage as a liability because they own your debt. You make payments to the bank. So what really happens here is there's actually two simultaneous money creation events. The first one is this creation. The money is made available for you, the buyer, to buy the house. So that is, I'm just gonna draw that in the green. So this deposit, and then of course this deposit as an asset, and then of course it transfers to the seller of the house. This is sort of one money creation event. This one looks very similar to the first example. And then of course there's a second money creation event, which I'll draw in blue, is the two sides of the debt obligation. This is the second money creation event. So basically, we have two cases where we just, from nothing, we create money and anti-money once again. And okay, so this is when someone might be confused. You might be thinking in your head, this chain above, that in order for a bank to give out a loan, they actually have to have money in the bank. And why does the bank just open a account for this loan instead of just giving you the money that they have in their vaults? And surely they must have money in their vaults, right? Otherwise they wouldn't be a bank. And, of course, the banks do have, lots of money in their vaults. Let's just say in this case, they have 100 million cash in the vaults, something like that, some large amount of money. And you might be asking, why doesn't the bank just give some of this cash to you as an asset and instead of opening an account? And the reason why is because obviously if you bought a house, I can ask you, did you lug $1 million in cash to buy your house? Probably not. We live in a digitized financial system where digital accounts is actually the main form of currency and not cash. And in that world, even though this could happen, I'm sure in some places in the world this does happen where there is physical cash moving, the easier thing to do for everyone involved is just open an account and the cash just stays with the bank. And the easier thing is just this green sort of creation, this green bubble creation of just this deposit. And yeah, this is a really interesting event because it's sort of a double money creation event. It creates money in the form of checking account deposits, and it creates money in this mortgage, which is repackaged into these mortgage-backed securities. They become CDOs, and then all sort of these fund investment vehicles. Okay, example 3. Treasury bills. This one's fun. So this is government debt. So the government needs money to pay for the military. What does it do? It can collect taxes, but if it falls short, it must issue debt. So on the left, we'll have the Treasury. And on the right, we have, let's say, JP Morgan as an example. And initially, so we have, once again, the assets, liabilities. Initially, let's say JP Morgan has $1 million cash. And the government needs to borrow money. So what the government does is it creates a T-bill and it sells it to JP Morgan for cash. So the cash moves into the hands of the Treasury. And JP Morgan gets in its place a $1 million T-bill. And then the Treasury is running into debt, so they have a liability. They must pay off this $1 million T-bill over time. And, okay, so what this money creation event is very similar to the mortgage money creation event. It's the money itself, the money and anti-money pair is this debt claim, but this time on the government. And, this asset that JP Morgan gets becomes part of its balance sheet. They trade it up between other firms. They sort of loan against it. They do all sorts of things against the asset of this T-bill. The treasury market, as you may know, is a very liquid market. And even though it's just, quote unquote, a debt obligation, it's sort of treated as if it was money. And why not, right? So if you remember lecture 1, I defined money as a credible promise for something else. And in the case of the government issuing debt, the U.S. government is considered the most credible government and the most trustworthy government in terms of its debt. So while if you were to do this, maybe that would not be considered a money creation event because you have substantially less credibility in the government. But the government here is considered to be very credible, and it's considered to have, is considered to not be sort of in the realm of default. So this pair of the T-bill does satisfy the definition of money from lecture 1. And so does sort of everything else in these 3 examples. So going back to example number 1, the real reason why this deposit creates money, it's a money creation event, is that when you have money in your bank account, when you log on to the website and it says you have $1,000, you trust it. The bank's claim that you have $1,000 is a credible promise of payment in various forms. And we all trust the banking sector, and we all trust that number. And therefore, this blue circle in example 1 is a money creation event because it represents a credible promise. And, in example 2, we have the same promise in the green circle with deposits, but we also have another promise in the blue circle, the mortgage debt. And the mortgage debt is very interesting because the mortgage debt is a debt on private households and maybe sometimes private equity firms, but for the most part, it's private households. So you may be wondering, well, the average household is not nearly as credible as the U.S. government. And, sometimes people default on their homes and they get foreclosed. So why is the blue circle money creation? It doesn't seem like it's a credible promise for something else. And the reason why it is because of collateral. So collateral, and this is why foreclosure happens, the house is the collateral that backs this mortgage. So even though a particular family might not be credible, the threat of collateral makes the mortgage a credible promise, and therefore actually gives the mortgage itself the character of money. It becomes a credible promise for payments because in the worst case, where the payments don't happen, the house can be seized, it can be sold, and the future promised payments that the family defaulted on can still be met. So this is why household debt in the form of mortgages is sort of also a money creation event and is seen as credible, just in the same way as the U.S. government debt is seen as credible. But in this case, it's primarily because of this mechanism of the collateral being the house. So those are some examples of the stage 1 money creation. I will, as a final note, on this example 3 of treasury bills, this is not printing. So when people talk about the government printing money, this is not what this is. The treasury issuing debt is a stimulative from a monetary perspective because it creates money. But this is not the same thing as the Federal Reserve printing money. And to explain what is meant by printing, I think that requires not only another lecture, but another lecture series. But for now, just understand that when people say the government prints money, they are not referring to deficit spending. Even though deficit spending, by definition, creates money in the economy. But this is not what's commonly understood as printing. We can explain what printing is at a future time. So that's stage 1. Stage 2 is trading. I think that'll be the next video. and we'll get into that. But at the end of this life cycle, it's stage 3 is deleveraging. So deleveraging is really just the end, the undoing of this initial process. So for example, one, deleveraging is when you go to the ATM to get your money out. And in example 2, deleveraging is when you pay off your mortgage. And in example 3, deleveraging is when the government pays off its debt over 2, 5, 10, or 30 years. And that's sort of when the money and anti-money merge back together and become nothing. And so to end off, we'll have a relevant Bible verse here. So this is Deuteronomy 23, 19-20. You shall not charge interest on loans to your brother, interest on money, interest on food, interest on anything that is lent for interest. You may charge a foreigner interest, but you may not charge your brother interest, that the Lord your God may bless you in all that you undertake in the land you are entering to take possession of it.